I don't even want to touch the markets because I can't control it. I want something I can actually control. I have something that I could actually exit out based on market dynamics. And after that, I was like, it literally was some nurse beat a patient up, and then like it went down, and then it went up like 2 months later. And I was like, dude, I would have literally had like a 6 or 7x on it. I would have been crazy. But after that, I was like, I do not want to be in the stock market. I just don't like the fact that I can't control it. Real estate, I could at least control. I could see like trends coming. I could get out. I could exit. I could cash out, refinance, or I could, 1031.
You're listening to the Millionaires Unveiled podcast, where you'll hear the stories and interviews of everyday millionaires. We'll unveil their decisions, their strategies, and their current portfolio allocation. Now to your hosts, Clark Sheffield and Jace Mattinson.
Alrighty, everybody, welcome back to another episode of the Millionaires Unveiled podcast. I'm here with Jace. This is episode 189. Jace, what's going on?
No, not a whole lot. Just rolling into the summer here, and graduation just happened for most people. That high school, college, moving on to the next phases of our life. It's getting exciting. Summertime.
Yeah.
You got any big plans?
How long is this market going to keep going? I don't know if we're talking stock market or housing market or lumber market or whatever.
It is insane. I'll tell you on the lumber side, at least, that there are some more mills coming online. So I think we're expecting to get some price relief here, at least probably into the fall or late into the year. Hopefully, nothing's ever guaranteed. But in terms of house prices, man, it's just skyrocketing. Most markets that I've looked at or looked at or have people in or that I know about. So who knows on that front? I mean, interest rates are still pretty low. Seems like they're going to stay pretty low. So purchasing power is continuing to be large for most people. And there's a bunch of money floating around, a lot of liquidity in the economy. So who knows, man? You got a crystal ball?
Maybe that's what it'll take, right? Is the increase in interest rates?
Yeah, I mean that could be one of the levers, right? Slows it down, or who knows? I mean, he's got infrastructure bill up for debate right now, and there's all sorts of things that are moving markets and continuing to push stock prices higher and housing prices higher. So.
Yeah. So just a quick summary from last week. We had Robert, a 28-year-old dentist. A lot of people wrote in this week with questions for him. So just a reminder that you can go on the website. If you click on the podcast tab, you can click on the actual episode. So this would have been episode 188, and you can comment or leave comments. And then, of course, we'll let our millionaires know that that's there, and they can come and respond to questions. So hopefully they do that, and then you can interact a little bit and ask some of these more personalized questions, because I know there were a lot of questions on his net worth. So just wanted to touch base on that. In today's episode, we have Jonathan. He has a net worth of $2.9 million, all real estate. So interesting interview with him. I feel like it's been a while, Jay, since we had somebody that was all in real estate. Yeah. Of course, it seems like a lot of people dabble, but haven't had somebody for a while that's all real estate. And we have some coming up that are all market investments as well. So kind of hitting both sides, as well as some small business owners and people that are split between numerous buckets coming up. So fun interview with him. If you're interested in any multifamily investments, send us an email, millionairesunveiled@gmail.com, or you can go online and learn more about that at our website, millionairesunveiled.com. If you'd like to be on the show, or if you'd like to write in or ask a question, you can leave a voicemail, and we'll play it during the show for our millionaires. So feel free to do that. Again, website, millionairesunveiled.com. So thanks for listening. Thanks for tuning in. If you enjoy the show, we appreciate you leaving a 5-star review on either iTunes or Stitcher or SoundCloud or any of the platforms you listen to. It helps us reach new millionaire interviewees and keep things going here. So just wanted to read a review we got this week from Midwest to LA, titled My Favorite Podcast. It says, Jason Clark have struck gold. This is without a doubt my favorite podcast, and the first one that's motivated me to dig into the archived episodes so I can hear every last one. The co-hosts don't make recommendations, but rather observations, as they interview millionaire next door types from all around the country. I've shared episodes with friends and already started making small pivots in my own life to get 1% better, thanks to the best practices I'm picking up from the millionaires, multimillionaires, and soon-to-be millionaires who have each achieved success in their own unique way. And success, as they reinforce with each episode, is not about the money, but rather the happiness, experiences, and lifestyle freedom that money provides. Keep up the great work, guys. So thanks for that, Midwest to LA, and thanks for listening. Of course, thanks to all of our millionaires. That's what makes this show keep going. And without any further delay, let's get into the episode with Jonathan.
Jonathan, you want to just give us a little about your background and what you're up to now?
Sure. Thanks for having me on. I love this show. Involved in the manufactured housing space. It's a very unique niche, mobile home parks, some people call them. With a partner, we have a Mobile Home Park Fund, and I also have an info course in that, and a couple of digital products, including digital agency and 2 e-com stores.
Wow, you're a busy man.
Yes. But the digital part is convenient because it's mostly automated, and you could build systems and structures and teams. And the mobile home park space it's a older, it's kind of like multifamily, but you can still really build out the structure and bring in the right pieces and puzzles, and moves pretty well.
Totally. Is there one you enjoy more than the other?
I actually like both. I like the digital side because you could do it while you're anywhere. Like I could do, check on, the old school Ronald Reagan, trust but verify. I could look over the shoulder. I could see what's going on digitally anytime the systems process and like the algorithms. But I do like the manufacturer of mobile home park space because no matter what, it doesn't get beat by technology, because no matter what, people need affordable housing.
Yeah, totally. So, Jonathan, what is your net worth today?
2.2 million.
Awesome. And how is that broken up?
It's all real estate, so it's good and bad. But right now, my focal point this year is I have the fund just came out, so we're acquiring. We're doing a $10 million raise. So over 10 years, I should go up drastically higher. Then I also have basically the digital side is more cash flow, so I expect it to go up a lot in the next few years based on like the positioning.
And when you say it's all real estate, is that all in manufactured housing real estate, or do you have primary residence or other rentals?
Yeah, exactly. It's all manufactured housing. It did the, I don't know if you're familiar with like Wall Street Journal. They had an article this year. I think it was like January, February, and they said literally the best asset class or top performing asset class is very similar to multifamily, very similar. But they said the best performing during the last downturn is basically because supply and demand was mobile home parks, because you can't really develop new ones. It's very hard to get zoning approval, and there's about 60 million Americans that need affordable housing and about 12 million mobile homes. So it's just like this whole supply and demand curve, and it really helps serve affordable housing, and you can't develop it, so you control the market basically.
Yeah, that's totally interesting. I want to get more into that. How did you get started in manufactured housing?
Yeah, great question. Like literally when I used to tell my friends like 15 years ago, my dad was a real estate developer, contractor, and I grew up in the 80s, and like literally saw my dad. I had 3 real estate offices. He did about 30 flips in the 80s, and in the 90s he did about 80 custom homes. But late in 2005, 2006, he got his first mobile home park. And when everything else was going down, and like you have all these problems, and right when the last crisis hit, like 2007, the manufactured housing like just was stable, sturdy, and I was like, this is what I need to get into, because it's unique, but there wasn't like the word of mouth wasn't big back then. And I used to tell my friends, I'll be like, oh, that's really weird. They'd be like, this is a really weird niche. I'm like, trust me. And then like now it's like mainstream media. You have like Wall Street's really big into it. Warren Buffett has $2 billion companies, 2 separate $1 billion companies. He's the biggest manufacturer of financing and new home manufacturing. And additionally, Sam Zell, which is the biggest, considered probably the top real estate investor ever. He's the biggest owner of multifamily, the biggest owner of office building, and the biggest owner of manufactured housing parks. He sold half his multifamily and half his office, and kept all the mobile home parks and is acquiring more. And so seeing all these trends, and then also all the Wall Street firms like Carlyle Group, Apollo, and Blackstone are the 3 biggest private equity, basically the 3 biggest private equity groups, and they're all buying billions and billions of dollars, including last week, Blackstone, which is the biggest owner of single family housing in America, to spend $550 million additionally in the mobile home parks, because they see that's the niche going in the future.
Yeah, it's definitely an interesting space, and we've had, I think, a couple guests, Clark, that have been involved in the space, but not very many. Definitely not, in terms of the amount of millionaires we've interviewed, definitely not a big proportion at all. Most of them have been more involved in single family or multifamily. So if somebody wants to get started, let's just say, is it easiest to go and invest with somebody who's got a fund, or is it possible to go buy, a handful of these, or how does it work? Give our listeners kind of a breakdown of how it works.
Yeah, great question. And I'm not biased to any niches. I like all real estate. I like multifamily. I like assisted. I like a couple other niches. But what I do like about mobile home parks, I think the best avenue is probably to get your boots in the ground, just doing a couple flips of like the actual units, because you actually see the dynamics that goes on. You see the demographic. You see the challenges. And then probably, not just because I have a fund, but like Any of the funds out there do pretty well. You can get a small taste without putting down, like, even if if you're trying to acquire a small park, you're going to still need $300,000, $400,000, $500,000 plus some capex. You don't know the ropes. You could do some courses, to teach you kind of like the ropes, but you're going to learn basically from having mentors. A fund, you get in most of these funds for $50,000 down, but they also have the quarterly calls. They teach you what's going on, the demographics, the trends. They kind of give you like a breakdown. I think if you're just trying to get your feet wet, probably the easiest path would be flip 1 or 2 units, like some cheaper units. You get like late 70s, after HUD, early 80s units for $5-10 grand. Flip it, kind of see how it works, and then also maybe do any of the funds out there are really good, but you're not putting out $500,000, $600,000 without knowing the path. That's probably the easiest way to get started. And then if you kind of learn the ropes, then probably do your own park or do a small park.
So you say, Jonathan, just jumping back to your allocation here, you say most of it is in real estate. Mm-hmm. How much of it is in real estate outside of your home, and how much cash do you hold?
Yeah, it's all like I'm technically considered a money manager with the fund. I have a couple of properties, but I'm not a big fan of single family because I don't like the fact that you have the recourse. You have not only that, you don't get the same, like, for example, for the multifamily or mobile parks, we have a 15-year K1 tax depreciation schedule, and multifamily get 27.5. So I like the fact you get the tax depreciation schedules on commercial real estate, and like I rent. I have the cash flow from the properties. I lived in for the last 6 years, like pretty prominent building. It's called River North Chicago. It's like Derrick Rose is one of the units in the same building. He was a former MVP in the NBA. A lot of doctors, but I have the cash flow from the property. So I don't like the fact being tied to a property. I like to actually have income properties that produce more than being tied to like a single family home.
Sure. So you don't have any in the market at all? Zero market investments?
In single family, no.
Not single family in the stock market. Sorry.
Stock market. No, actually, yeah. So stock market, I have, nothing in the stock market. I used to work in the board of trade in Chicago, and then actually in the pits, and with one of the most successful traders. This is about 15 years ago. And then I bought into SRZ. This is probably 2010, after the last dip. It's assisted living centers. I bought it at around 2.25. Kept buying in, and I started doing some margin calls, or not margin calls. I kept buying and buying, and then I had it literally went from 2 to 250, and then went to like 7, and then there was it's like straight out like Billions episode from Showtime. A nurse beat a patient, and I was borrowing on it because I was kept going up, and then a margin call, multi-6-figure margin call. I bought it 2, went to 7. And then came back down, and then ended up being the number 2 performing stock of all of 2012. I would have made multi 6 figures, and I had the margin call, so I lost everything. So after that, I was like, I don't want to do. After working the pits and the board trade, which is New York and Chicago, the 2 biggest trading centers, and then I had that professional day account with Scottrade, and after that, I was like, I don't even want to touch the markets because I can't control it. I want something I can actually control. I have something that I could actually exit out based on market dynamics. And after that, I was like, it literally was some nurse beat a patient up, and then it went down, and then it went up 2 months later. And I was like, dude, I would have literally had a 6 or 7x on it. I would have been crazy. But after that, I was like, I did not want to get into the stock market.
Yeah. So when did this shift? Was it always that way? Were you in the stock? I mean, it sounds like you were in the stock market and had a shift, or at what age did you decide to go all in on real estate?
Yeah, so great question. So I literally worked in the pits in Chicago from 2005 to 2006 and a half, or 2004 to 2005 and a half. And so I really got to see my trader mentor was one of the most successful traders in Chicago, and he worked in New York a little bit, but learned the trading trends, and he taught me all that. And after that, I waited till after the crash, in 2009. I started buying after I kept liquid. So I was positioned correctly. I was liquid. I was saving 35, 40% of all my paychecks from 2006 to 2009 after everything dipped. Then I was cause I do real estate. So I like the assisted living sector because there's 10,000 baby boomers. It's been that way for retiring every day. It's been like that for the last 10 years. I'm like, I like this niche. It's just like mobile home parks. So it really ties in. And I researched, it's called Sunrise still a huge player in the assisted living, Sunrise Senior Healthcare. And the guy, the CEO they brought in was a turnaround expert. I researched him, and he's like a long history of the CEO of like turning around huge companies. And I was like, okay, let me bet my hedge on him. And I put everything in that. And like, yeah, I was still young. I was like 28 this time. And I was like, let me let's see what happens with it. And like, it was riding really good. I'm like, okay, let me just keep going down, doubling down. And after that, this is 2012. After that, the margin call, I'm like, I'm out. So I just don't like the fact that I can't control it. Real estate, I could at least control. I could see like trends coming. I could get out. I could exit. I could cash out, refinance, or I could, 1031.
So, Jonathan, let me just play devil's advocate here for a second, right? Everybody who's invested in real estate since 2010 or 11 has crushed it, right? Where do you see it going? Are you well positioned if there is another downfall? Do you think that this has been abnormal, or what are your plans for the future?
Great question. I think it all depends on the niche. I think multifamily, depending on the city, it all comes on the macro or micro data. Because every region, you could be like in California, you could be in the Midwest. Every state and every region has different dynamics. You're going to see, obviously, on the commercial side, you're going to see retail's getting crushed from e-com. Obviously, hotels, hospitality, restaurants are getting crushed because they can't even be open, or the 25% occupancy or capacity. So obviously, that's going to really affect it. I really see my viewpoint is, I think, being in affordable housing or just like multifamily, for example. I also like assisted living because there's I don't know if you're familiar with it, but it's called the silver tsunami. They're saying that with the 10,000 baby boomers retiring every day, about 1/3 of single family houses over the next 10 to 15 years, they'll be put in the market. And so certain markets that are heavily senior focused, those seniors are going to like take their, equity, take the houses, and they're going to go to like multifamily, assisted living, and mobile home parks. So that's one thing I would suggest, is kind of seeing the trends and like the long-term positioning of it. There's 10,000. That's a large percent. And most of the baby boomers too, I think the average, it's about 30 or 35,000. That's the average senior that has in their cash in the bank account. And most of them have about $35,000 and then $1,200 a month. So it's going to be multifamily and affordable C-class multifamily. And then you also have mobile home parks. And then if they're affluent, they're going to go to the assisted living. So I think that's kind of trends you want to look out for, just based on those trends.
So say that stat again. What percent of the homes you said will become available?
This is, you could Google. There's been a lot of, it's called the silver tsunami. It's about 1/3 of the housing from the next 10 to 15 years. I don't know, data could be all I could shoot, but about all the seniors that are baby boomers, it's about 1/3 of the next 10 or 15 years are looking to get out. It's single family. It's going to really affect single family. So if you're like a Florida market, maybe an Arizona market where it's like a senior centric, and a lot of those, they're not, after they cash out of that or they sell their property, they're not going to go buy another 30-year mortgage. They're going to look for assisted living, C-class apartment, maybe B-class, and mobile home parks. So it really fits that trend.
Yeah, or they're going to pass away, right?
Exactly.
And then someone's going to inherit it, and their executor is going to sell it or keep it, I guess. But yeah, probably most likely sell it. And I've seen that too. And another conversation I've seen with that, and I think we've had on the show a couple times, is what happens with all of these rural homes, right?
Exactly.
That people move out of. And so I think there's a bit of a conversation, an unknown there, in the sense of, okay, are people going to live more urban or more rural, right? And when all these houses go up for sale because baby boomers pass away or move into assisted living or apartments, where does the housing market, the single family housing market, go? So
exactly. Great question. Yes, keep that in mind. That's a great question. Keep people in their thoughts.
So tell us a little bit about this fund. Tell us about where people can find it, how they can get a hold of you, and what you guys are really doing with it.
Sure. Yeah. So our focal point is mobile home parks in the Midwest. We like the Midwest because if you go to like California or the East or West Coast and the coastal cities, it's got affordable housing is not affordable anymore. Even like I don't know if you're familiar. It's called Paradise Cove. For example, in Malibu, it's like Matthew McConaughey lives there. It's a mobile home park that has like $2 to $5 million houses. Their mobile homes are $2 to $5 million. Crazy. And then on top of that, they pay, I think $2,000 or $3,000 lot rent on top of that. But the value to them is it's private. They have the same beach as the $15, $20 million house next door. And the best part is they're not paying $100,000 in real estate taxes. I think they just pay like some like motor vehicle tax for like $40. There was like some big article, like Google it. It's $40. I think they pay in some like, so the neighbor's like, hey, we have the same beach as them. They have their $5 million house, like mobile home, but they're not paying $100,000 per year in taxes. And that's another really value about mobile homes and helping affordable housing is even, for example, in the Midwest here, in these small towns, secondary and tertiary markets, even like like Illinois and California have the two highest, basically the tax overall. Illinois and California are horrible for taxes in general. You know, we're notorious for it. We don't get the nice beaches, we don't get the nice weather, and we don't have like ocean views. We're in the middle of nowhere, but we still get taxed like crazy. But if you're in this small town, you get the same fire, same police, same school, everything the same, but across the street, in this $150,000 house, you're paying $2,000 to $3,000 a year in taxes. But this mobile home across the street, you're paying $10 a month, $15 a month. So you save $2,000 or $3,000 a year. And the average mobile home tenant says 14 years. So you save $45,000. It's not technically equity, but it's money you save through taxes. And and for example, National Association of Realtors even talked about Cook County, Chicago. In the last 20 years, it hasn't really appreciated. Like the real estate hasn't, like Illinois is not like, it's not like people move here, but it's not like super desirable. People are moving out. I think we're the most moving out state of anything. And then they're moving to Texas, Tennessee, and Florida. So if you see those trends and you see the value that manufactured housing helps solve this affordable housing by providing all this tax benefits for the residents, it's a really cool niche. And our focal point is buying the Illinois, Ohio, Wisconsin, Iowa, basically the Midwest, Texas, Tennessee, and just getting, because the reason we would like it, because I was going back to the previous conversation, our cap rates are a lot higher. It's very stable. There's not as many mobile home parks here. And the best part is you have really the most favorable taxation structure on your K1. So traditional commercial real estate is 39 years, multifamily, which is great, 27.5. And then mobile home parks, the land improvements, which is like 75, when you acquire a park, 75 to 85, it's 75 to 80% you could write off. So you have these really cool for the land improvements. You have a really cool taxation structure. You serve affordable housing. And our goal is to just acquire as many parks over the next 3 funds. It's getting really, really competitive. I've been in the space for 15 years with my family, and everyone like going back to seeing like the retail properties closing, the hotel properties. So these people like, where can we put our money in, our capital in? Because we need something that could be recession proof. And like ours is notoriously really strong during recessions because supply and demand. And then people that are middle class, okay, they lost their $50,000, $60,000 job, but they have a $30,000 job, but they have money saved. They go into mobile home parks. So we always have this demand for affordable housing. And that's what we serve. And we try to bring that position that correctly for our investors.
Yeah, Jonathan, it's super interesting, the mobile home park niche and just the way that you're talking about that and returns. Just for our listeners, when somebody goes and invests in a mobile home park, what are they looking for? And what's maybe an expected return range that somebody could expect investing in a mobile home park?
Sure. And in the last 5 years, it's gotten like so many Wall Street, obviously Apollo Group, sovereign wealth funds have bought billions of dollars. And then right now, the benefit we do have is now Fannie and Freddie financing, which is the best. Basically, they're doing 10-year non-recourse, which means you're not liable, obviously, and then they have 35 or 30 some percentage is allocated to affordable housing. So they have to donate or they have to like lend to affordable housing, and mobile home parks have been their favorite niche. And actually, this is the first time ever. We're the high 2s or low 3s in qualified parks. And this is actually a little bit lower than multifamily for the first time ever. So we're like competing with that. And what that also does is our cap rates are going to compress. So everyone knows about our niche before. Like you talked about this 10 years ago, it was 10 caps. So it was like just even like 8 to 10 caps. 10 caps would be secondary tertiary markets. More major metros would be like A caps. Now 6 cap is the new A cap. But we're lucky though. The good thing is we're lucky because we have the supply and demand, and then with the financing, you have that nice split, 3-point split between if we're getting financing at 3% on Fannie Freddie financing, non-recourse, very qualified, it's a great position because you also have that split. And with the Treasury, last year, the 10-year treasury was 1.65 approximately. Right now we're like 0.65. So we have these great lending options right now. So you can still have that. Yes, the prices sound crazy, but you have that nice, that nice spread between the note and the actual cap rate. So it's still attractive. But like if you were in this space like 5 or 10 years ago, you'd always hear all the 10 caps. And like even people still talk about it, but it's like becoming such a rarity. There's about 6% institutional investors, but that's, and most everything was mom and pop. But now mom and pop see like, hey, we're on the news, we're all these magazines, like mobile home parks are the hot deal right now. So now they want like the best possible price, and then everyone's reaching out through mailers, phone calls, prospecting the park, and then obviously the brokers. So the rates are about 6.5, 7.5 cap. If you're in the coastal cities, you might even be like 5. Just it's very comparable to multifamily, honestly, and a little more. It's a little more management work. It's like you can have like a nice management, third party management. If the underwriting is a little bit different. That's when people come into our niche. The underwriting is a little bit different than other asset classes. Not the same as vice versa. If you're a multifamily or mobile home parks, it's not the same. Obviously, we're basically vehicles, and you want to be either land leasing, it's tenant-owned home, or the park-owned homes. And then when you're doing the Fannie Freddie, they want to see less. Obviously, they want less liability, so they don't want you to park to own all the homes. So the major market metros, you're seeing high 5s, low 6 caps. It sounds crazy, but the good thing is you have like the tax benefits from the K1, remember, so the 15-year for the land improvements. You have that factor, and then you have the fact that it was, like Wall Street Journal says, been the best performing asset since the last downturn. And then it's also the lowest bank failure rate for the last 50 years based on bank data. So it's more of a stable investment. It's very similar to like self-storage / multifamily, but it's not as the stories of like, the hype. It's getting more and more compressed and more competitive.
Totally. So, Jonathan, where do you go from here? Do you have a target net worth you're trying to hit or passive income for yourself?
Yeah, good question. I think 10 million. 10 million, I think, because a couple million, like I'm in Chicago. If you mentioned New York, it's expensive to live. If I go across the street, a salad's $14 to $17. Rent's $3,000-$4,000 minimum. It's just really expensive to live, and they actually have something sustainable and help provide for others. I think 10 million, and then minimum, I want to get to 80,000 in personal income a month. And it sounds like a lot, but I want to have that where it's like where I can have something sustainable long term. Because $100,000. I made my first $100,000 my first job, like in sales, and I got kind of spoiled by that. And like that was 15 years ago, and I was making 150. And I was saving 33% of my money. And like, it didn't go very far. And like being in like, if you're in I'm like in these small towns, it goes a lot farther, but you're in a major city where, you go out, it's $100, like $100. And like the cost of living is just so astronomically different. That's why I want to get that number. And I've basically, over time with inflation and everything that's going on, I think 10 million is the number.
Gotcha. So let me just ask you psychologically, what motivates you to get to that 10 million? Is it the desire to not be poor? Is it the desire to live off the passive income? Is it the desire to retire early? Is it to provide for your family? What's really driving your motivation here?
Combination of everything. I think always, and being an entrepreneur, you're always driven because not everything is easy and you have to work so hard for it. And like every up and down, every cycle and every trend is like, okay, I have to really position. And the older you get, you start seeing trends. And I've studied a lot with, recently, I just learned about the 1907, the panic of 1907. It was pretty fascinating. Obviously, I know from the family of the savings and loan disaster of the late 80s, early 90s. So always understand the risk averse. Like there's always upcoming challenges and those things are not going to go as planned. And so that kind of gives you that, like, just to keep pushing, just to be A, to help people, A, to like serve other people, or B, and then just really understand that like, things could always change and pivot, and you have to be well positioned. And all it comes down to, like, really just keep moving forward and keep pushing forward because it's not easy.
Yeah. So just wrapping up here, I want to hit some rapid fire questions. What's been the most expensive car you've ever purchased?
Good question. So I bought a CLS in 2007. It was 2006 for $63. But here's a funny story behind it. I literally walked into the dealership. I crashed my CL before that. Then I got like a $6,000 basic Toyota. I pulled into like outside Chicago. It was like a Bentley dealership. Literally nobody walked up to me. I'm like 26 years old. Like I literally walked around the parking lot like 3 times. I called them up like, hey, where's the CLS? I saw it online. Like, where's this at? Like where you at? I'm like literally in a parking lot. The guy drove me there, pulls me back to like inside. We found the car was at the other location. We drive it back. I ended up purchasing it. And the whole moral of the story was like literally nobody went up to me because I was a young kid. I just was in regular street clothes. I pull up in like a normal car, and they just judged me based on that. And I'm on the car, and the guy gets up and he's like, "You guys ignored him for like 5 minutes," and he ended up on the car, and they were all like agitated and pissed off. It was pretty funny though.
So what's worth the money to you? Is it cars? What's worth spending more money on?
No, I mean, it comes down to the thing. I bought it in like I could actually make money on it. So like, there's a whole thing with like, if you get like a car, I bought it in February and end of February, early March. And it was normally the other dealerships were like $5,000 or $7,000. And it was a CLS, which kind of like, it was like a year old at this point and a little higher miles, but like I bought it off season. So you could actually do it. I know there's people that teach us, like you buy it off season, drive it for a little bit and they could flip it. But, no, nowadays I mean, the last 5 years I've been doing Uber. I'm so low key nowadays, like especially the niches I'm in. Like I'm literally low key, my own brand T-shirts and just low key. Yeah. But like that was when I was younger. Like everyone was that phase. You want to like, hey, I got this.
How old were you when you became a millionaire? Do you remember?
About 37. Officially, it was through like just basically paying down the note. Yep.
Okay, and how much do you spend annually? Annual household spending?
175. My bills are pretty high.
175. And what's your beyond rent? I guess rent's probably your biggest, right? Because you don't have a primary mortgage. But beyond that, what are your biggest expenses?
Food, entertainment. I like going. Well, nowadays this year it's actually a lot lower. But normally I go to like a lot of sporting games, and I usually do the stub up. And I always want to be like the first or second row. It's just like, nice. It's a fun experience. I like going there because you can actually like hang out. Like players give you a high five. It's fun. So.
Yeah. As much as you're comfortable sharing here, what's been your range of household income through your working life?
I mean, like when I first started working, I worked this, I don't know if you're familiar with this, but it was called BB. It was a clothing store back in like 15 years ago. I ended up being the number one seller in the company. And I started off at just hourly. It was $8 plus commission. And then I ended up being, after my first year, I ended up being the number one in the company. And I was started from 125, 150, 170. And in today's money, because I was like 2006 to 2009, about 170 to 190 with the value of money today. And then 2011, 12, it was terrible. Like I had that, like I mentioned, the SRZ Sunrise. I was like, oh, this is gonna be great. And I got, I just got into real estate at that point, the brokerage side. I had like 2 years. I just literally lived off savings. It was bad. And like, and then I got into the park side with my dad. So like that was my saving grace. And that's why I'm like so loyal to that business. And then the last few years has been like tech with this. And then the next few years is going to be crazy with the fund. Yeah, it's going to be good. I'm like really excited. And I think I'm really well positioned based on obviously tech's always going to do really well. And then the mobile parks do really well during recessions and just, and I have everything positioned correctly now.
Nice. Good for you. Obviously you've been extremely successful. So just final question here, and I know you mentioned some advice and Jason talked about how to get started, but what would be your final advice to somebody or any mistakes that you've made that you would caution against here in closing?
Great question. I think the biggest thing is go out and find, like my biggest thing is like, I'm fortunate now, but like I had to go out and be in the room where you feel uncomfortable. Go out to people and just don't ask for advice, just listen and get into the room. Like, try to get in front of 8, 9-figure entrepreneurs, but don't just like ask them for their time because their time's worth so much. Either you pay them or help them out and somehow kind of compensate them and get those relationships because those are going to end up paying you. And like when you learn from someone that's 8, 9 figures, they're going to tell you like very creative structures, how to think differently, how to structure things, and not just listening to typical advice you've seen in books and stuff. Like, I love books, but like having that like a live mentor and just getting those mentors like really kind of position you correctly. I think that is the fastest way to success. And I really encourage people to like go out and find people that you really look up to and they're like doing honest hard work. And if they're still doing boots on the ground, they're still working and they have tens of millions of dollars, those are the people you want to go after because they actually still care enough that they're still doing boots on the ground. They're still working day to day, even though they don't have to. So I think that's the fastest way to success is really find those people in your local market, like wherever you can reach out and it'll be intimidating at first, but you're going to get more and more skill set and try to add value to their lives.
Yeah, awesome. Well, appreciate you sharing the advice, and thanks for coming on and unveiling your story a little bit. So, everybody, that's Jonathan, net worth of $2.2 million. Thanks again for coming on the show.
My pleasure. Thanks for having me on, guys.
Thanks for listening to the Millionaires Unveiled podcast with Clark Sheffield and Chase Mattinson. For more stories, investment opportunities, and information, check out our website at millionairesunveiled.com. See you next time when you'll hear from another everyday millionaire.